Well, our special segment, Quarter Se Quarter Tak, Nigel has walked across to the big wall. He's going to take us through expectations from the cement sector. Nigel, over to you.
Well, strong cement demand was witnessed in January as well as February, though there was some slowdown in demand in parts of March 2023. Now, pre-election spending continues to boost infra segment demand in multiple states. That's what's driving the overall cement demand growth. Mid-team volume growth is expected for the bigger names, Ultratech Cement, Dalmia, Shree Cement, as well as JK Cement. They should report mid-teens, maybe 13 to around 16% volume growth. While Ramco Cement, well, that's expected to grow by close to around 20%. Now, the large will dominate and outgrow the smaller cement players. That's what the street expects. Companies with capacity additions in the past 1 year and with Southeast regional presence, well, they could marginally outperform the industry growth. Now, the volume growth for FY23, while if you're looking at Adani Cement Twins, that's ACC, as well as Ambuja Cements, they will be negatively impacted owing to the Himachal Pradesh plant closure for parts of the past quarter. Now, costs are likely to have started a downward spiral and will soften further in Q4 FY23. That's because of low energy cost, better operating leverage since volumes will be higher, and reduced maintenance expenses due to peak season. That's Q4. Now, this benefit of cost decline is likely to extend for a couple of more quarters based on the current prices of raw material and also at current energy costs. The problem is the volume push strategy seems to have impacted the pricing, and that's why prices were pretty much depressed in Q4 FY23. Some channel checks indicate that the cement prices at an all-India level have slipped and are likely to be flat to marginally negative sequentially. Producers in the northern region, they are likely to report some growth in terms of pricing on a sequential basis. And they are better placed in comparison to the southern states, where out there you've seen a sequential decline. Jeffries, they see that the energy cost decline and operating leverage will drive up the EBITDA per ton by an average of around 135 rupees per ton on a sequential basis. That's for their coverage universe. Adding that from their coverage EBITDA is likely to be largely stable for FY23, that's for the Q4, after declining by around 3 to around 44% for the past 6 quarters. There'll also be a good improvement for most companies on a sequential basis, and particularly for Birla Corp on a low base, while Dalmia Bharat, well, they'll see a bit of a decline on a high base. Well, a quick run through on the expectations of select companies is below. While Ultratech is expected to post a solid set, while Ramco's top line growth is expected driven by higher volumes. Finally, as we wind down, we leave you with a snapshot on the valuation front. So that's all the stocks up for you on the screen. Well, let's take this discussion forward. We have Mangesh Bhadang, the Senior Vice President Research at Centrum, who joins us on the show. Hi, Mangesh. Thanks so much for joining in. Well, what's your estimate? First, if you could tell us what kind of an EBITDA per ton improvement are you factoring in for Q4? And also on the cost side, what is the softening you're looking at for Q4 as well as for Q1?
Yeah, good morning, Nigel. Nice to be back after some time. So for this quarter, we are looking at 170 to 180 rupees improvement in EBITDA per ton, and that would largely be driven by the reduction in cost. So for the pricing front, as you mentioned, North was better as well as South was weak, so it gets averaged out a bit, and pricing is more or less flattish for our coverage universe. But the cost reduction is there, 170 to 180 rupees because of lower coal, and that's what is going to factor in this time around. Additionally, Q4 generally has relatively lower per ton cost because the volumes being higher, the other expenses as well as employee costs are on the lower side. For first quarter, again, given the fact that the coal prices have actually gone down further, now up to below $140 per ton, we are expecting that the cost should go down further by 150 to 200 rupees per ton. So this is the expectation for the first quarter. So that would actually be entirely be driven by the reduction.
Oops. Okay. All right. So 160, 170 rupees of cost decline. Mangesh, the problem for me is on pricing. Q4, in a seasonally strong quarter, you don't see prices moving up. That's a bit of a worry. So my question to you is that what kind of price increases are you building into your estimates for FY24? Because prices, even in the initial part of April, some price increases were not totally absorbed. I've checked with industry sources as well. So are you factoring in prices to improve, or is the earnings going to meet estimates because cost will be lower?
Right, Nigel. In the last 3 months, there have been 3 attempts to increase the prices, and none of them have actually been delivered. So they have not been absorbed in the market. Barring say 10 to 15 rupees price hike in the non-trade segment in North, I don't think any of the region has seen the kind of increase that we were expecting. But on the other hand, you would have seen that the volume growth was very good. I think industry should report a double-digit volume growth in fourth quarter, and we believe the tendency of the companies is that whenever there is a volume growth, they would actually go for more market share gains rather than pricing growth. So we are expecting that the pricing should remain stable. We don't see any upside from here on. In fact, if it remains lower or if it remains stable at these levels, probably the EBITDA per ton expansion should be driven by the lower cost. So they don't need to increase the prices substantially from here on. I would be happy if the pricing remains stable at this level, and we are not building in any price hikes for FY24 coverage.
Oh, okay. So that's good news then. If prices don't go up, then it's pretty much par for the course from you. But Mangesh, as speaking to various industry sources, some bankers as well, it seems that inorganic activity could still pick up in FY24. Maybe from not the names that we heard in the past, maybe some of them will not participate, but some smaller assets, 8 to around 10 million ton assets could be on the block. Have you picked up something like that? And do you think that there could be some consolidations in some parts of India? Will it be in the West? Will it be in the South?
Yeah, so Nigel, if you look at the balance sheets of the large companies, the kind of balance sheets they have, it is actually very easy for them to go for acquisition. But as you know, it is very difficult to point out which are the assets which would actually go for sale. So if you look at most of the companies, the key factor which has actually in the past has worked for the acquisition or sale of the asset has been higher debt. So if you look at those assets, it could either be higher debt or probably because the promoter is not from the country, or probably they want to do something else and that's why they would sell the cement business in the country. So those are the things that we have seen in the past. And there are definitely buyers in the market, and the question mark is whether there are any willing sellers. However, we do believe that there would be a couple of deals that should happen in this year, but very difficult to name them at the moment.
All right. Final question then, Mangesh, before we let you go. What's your preference from the cement pack? Will you go with the big boy Ultratech Cement? Everyone was doubting there's going to be a new player in there, grab market share. But in fact, all that pressure out there, the stock has got bought into, and now they're expanding. Volumes are looking good as well. So you stick to the large cap name, or would you go for some value buys from the broader markets?
So I generally we bifurcate our top picks based on the market cap. So for the large cap, we like Ultratech and Ambuja. And for the mid cap segment, we like Birla Corp and Nivoco, which are more of the value buys, wherein we expect that there's going to be some growth as well.
Okay, thanks a lot for your thoughts and what to expect from the sector. By the way, the market is cool.